All right, good morning, everybody. Hope you can hear us just fine. Thank you so much for coming to today's webinar on how to forecast your cash flow. Let me just turn my music off here real fast. Hopefully you can hear us. Down below, you should have a chat button that allows you to speak directly with us. Before we get into introductions and all that stuff, I want to make sure you can hear me. So go down to the chat button and let me know, can you hear my voice all right? Can you see us and can you hear us? Can you guys hear us? Give us a thumbs up down below in the chat. Oh, excellent. Angela says yes, she can hear us. Okay, great. And there are a few more people rolling in, which is a good sign. We had a really big snowstorm here in Utah. And I'm blaming the attendance today on the snowstorm, but hopefully more and more people will show up. Usually we have a whole lot of people rolling into these things, but today is light, which is a good thing for you if you're here, because it gives you access to Ryan for the next little bit, which is a pretty cool thing, actually. Ryan is our lead CPA and our CFO. He's the director of our CFO division here at IgniteSpot. So if you've ever wanted to speak with a CFO, get questions answered about your business, what a great time to do it, because class is slim today. So that's awesome. Well, my name's Eddie. I'm the CEO of the company, and we do this once a month. We call it Lunch with the CFO. It may or may not be lunchtime wherever you're at in the world. I don't know. We just try and shoot for it that way. And super happy that you guys are here. And this is one of my favorite and probably our most popular webinars that we've done in the past. And so curious to see what you guys think of as we're going. It will be recorded. And the topic today is how to create a cash flow forecast for your business. So we are trying to help you figure out how to get past the really the headache of just managing your most important asset, which is cash. It's a stressful thing. It's sometimes terrifying being an entrepreneur. I remember when I first started this company, I spent hours and hours every day looking at Excel spreadsheets, trying to manage every penny just to keep the payroll up and running. It was a hard thing. So that's what we're working on today.
That is.
Okay,
yep.
Awesome. So before we get into this, anything they should know about what we're getting into?
Really, if I were to precursor it with anything, this is my foundational tool. Anytime I start with a client with CFO services, this is the most important foundational tool I always start with. And we'll go through why, but this is the foundation of everything that you should be looking at if you're going to be looking forward in your business as opposed to looking in the past.
Yeah. So real quick, down in the chat below, let us know why you're here today. What is it that brought you to the cash flow webinar? Why are you interested in learning about this? And what are you hoping to get out of it? And while I'm waiting for your answers, or the answers to that question, let me just tell you how this works. So we usually spend about 45 to 50 minutes talking on this topic. Sometimes it goes faster, sometimes it takes a little longer, but we get through it pretty rapidly. We will share my screen here in just a second so that you can see what Ryan's talking about. And then what happens is you can, down below, just in the chat box, go ahead and just ask your questions. I'll be moderating the chat window to make sure that those questions get answered as timely as possible so that nobody gets left out. I think that's really it. As I mentioned again, it is recorded, so we'll be posting these on our website as soon as it's done, and you can have access to it forever. So a couple questions are coming in. Good. So Owen says, I'd like to hear the do's, don'ts, and hazards for creating a cash flow forecast. So it's something you can screw up really easily.
It is, and if you don't look at it correctly, you can actually give yourself bad information.
Yeah, absolutely. Okay. And then Joseph says, would like to learn best practices and technology that would make my life easier. I like it. Cool. Is everybody here a business owner? I would assume that you are either a business owner or at least in a management position of some kind and responsible for the utilization of cash. So just curious to know where you sit in the world. Okay. Let's get started.
Okay.
Shall we? All right. I'm going to share my screen here real fast, and we will be off to the races. Okay. So what are we looking at, Mr. Ryan Steck?
Well, what we're looking at is we're looking at the standard template that I build for all clients as a beginning part of any relationship I have with a new CFO client.
Okay.
This is where I come in, and anyone who comes on board with IgniteSpot, this is what they get. They get the very first thing I work on is a cash flow projection.
Okay.
And I break it down into sections. And we've started here on the summary tab, which is our first tab. We're actually going to come here last.
Okay.
So what we're going to do is we're actually going to go to the 2019 actual.
Okay.
So what I've done here is I've created a dummy account. So I've taken 3 different clients and I've smashed them together and moved accounts around. So it's not one client anymore, but I've taken 3 of our clients, smashed them together so we can see an example of what a cash flow projection might look like.
So we just built this in Excel.
Yes.
Now there are a lot of softwares out there that you can use to cash flow to forecast cash. In fact, Joseph was asking what's the best technology for forecasting cash. You've gone through a lot of those software tools,
right?
And yet you still come back to Excel. Is that because we're old-fashioned?
No, and it's actually not because there's bad cash flow forecasting tools out there. Okay. And this is important to understand. Okay. The reason I'm in Excel is because I want to do more than cash flow forecast for you. Okay. So when you come onto IgniteSpot, I start with a cash flow forecast. And then there's going to be 20 other different reports we work on. And unfortunately, there's not one software that has all 20 reports that I want. You can go out and buy one software for cash flow.
Another one for employee capacity.
Right. And all of a sudden you're 30 softwares deep and spending a lot of money on things that you don't need and don't really actually work together in any way. Yeah.
So what Ryan's talking about, just so that you guys know, we do outsourced accounting for businesses. This is not a commercial. We don't want to share that, but he oversees CFO services. He provides CFO level services to our clients. And so, like he mentioned, there are a lot of things that client probably needs more than just looking at cash flow. You know, right. When do I hire employees? When do I fire employees? When do we move into new verticals? When do I work with investors and shareholders? All of those things require some specific massaging of numbers. Right. And Excel is really the tool that allows us to do that the best.
Yeah. So, okay. But there are some good cash flow tools out there. Yeah. The only issue with them is they do have limitations on how flexible they can be with information.
Right. They are getting better, though.
They are getting better.
Yeah. Good.
But yes.
Okay. So let's dig in. And this is the nice thing about it being in Excel is this something you can open up on your screen as you're following along with this, and you can kind of build something similar as you're going. It's not that hard. It's just about looking at it correctly.
That's correct. Yeah. Yeah. None of this is rocket science. It's just understanding how it works in the mechanics.
How to think. Okay.
Yep. So if we look at this cash flow forecast that I've created, this is based on 2019 numbers. You can see this tab I've called 2019 actual.
Down here at the bottom.
Yep. Okay. So what I always do is I create a schedule that shows me what the company has actually historically performed. And as each month passes, I put in the actual numbers each month. Okay. So that we have a schedule to say from a cash flow standpoint, what is the company actually doing?
Okay.
So how this is built is you can see on line 7 there that we start with beginning cash. So what that is we start with the cash balance at the beginning of every month.
Okay.
And then,
so this should be beginning cash right here.
Yep.
So that would be the cash on December 31st, 2018 or whatever.
Right. Out of your books.
Out of QuickBooks, once they've been reconciled.
Exactly right.
So this is not you went to your bank account.
No.
Yeah. Be careful there, guys. A lot of you, when you start your cash flow forecast, you'll log into your bank account, you'll look at your bank account balance and say, okay, that's my starting cash, and you'll start using that number to forecast cash. That actually is not your cash balance, which is what Ryan's talking to you about, because there are checks you've written that haven't cleared yet. There are checks you've received from your customers you haven't deposited yet. All sorts of variables in there. You need to turn to your bookkeeper and say, hey, bookkeeper, I need my reconciled cash balance as of the end of the month. That's the number you want to use.
That's exactly right. So that's the cash number we start with.
Okay.
Now here's the easy part. From here, what we do is we take from line 8, where you see that income line,
okay,
and we go all the way down, and we'll come back up to some of these sections in a minute. But if we scroll down,
all the way down,
till we get to net income, okay, all the way down to line 57, all I've done after that beginning cash line is I've just cut and pasted right out of the financial statements. For us, it's QuickBooks, but I've just cut and pasted the profit and loss right out and pasted it in here.
Okay. So you opened up your profit and loss statement for the same period. You would have to have gone to January.
Correct.
Showed the whole month of January's income statement or profit and loss statement. And it would have given you a report that showed your revenue and your costs and everything else. And then you exported that to Excel.
Yeah, I just exported to Excel.
Copied the numbers, just dumped them in here.
That's exactly what we do.
Okay, so we've got your beginning cash balance at the top and the month's pasted P&L below.
Yep.
Okay.
Simple as that. So all right. Now, if you notice here, I have highlighted and bolded certain sections as I brought them in.
Okay.
So we start with total income.
Okay.
Obviously, we want to know how much gross revenue we have.
It's everything we sold.
Yep.
For the month.
That's everything we sold for the month.
Okay.
That's our very first line.
Right.
Then we go to our cost of goods sold section.
Okay, that's these guys right here.
Cost of goods sold, I want to spend a minute on because I want to make sure we understand what cost of goods sold is.
Okay.
And why we put it in as a separate item from our other expenses.
Okay.
Cost of goods sold are those expenses that are directly related to whatever it is you sell. So if you're a manufacturing company, Eddie likes to use the example of building a mouse.
It's right here.
Yep, go for it.
So if this is what you sell, your cost of goods sold would be the money that you spent on the plastic, the little rubber wheel, the machining to build the thing, and the labor really for the guy to stand there at the machine and pull the lever to make the mouse come out of the box, right?
Right.
The plastic packaging on it, the shipping to get it into Walmart so that I could buy it or whatever, that's all cost of goods sold.
Yep.
But your maybe your marketing or your meals and entertainment that you took a client out to didn't go into this,
right?
Or your insurance or your rent for your building didn't go into this,
right?
Yeah.
And so what we're doing is we're looking for those costs that are directly related to whatever.
Making the thing you sell.
Right.
Yeah.
Because there's lots of costs of running a business that actually aren't directly related to what it is you're actually selling.
Mm-hmm.
Ignite Spot's a good example if you're looking at it from a service standpoint. You just explained how it would be if you were actually building and making something.
Yeah.
If you're a service-based company, we have people here at Ignite Spot that are billable, meaning that they charge by the hour, or they charge by project, or they charge by client. They're people who are actually doing the bookkeeping and doing the work, so doing the consulting.
Okay.
Those are our direct labor costs that are our costs of goods sold. We also have people here who have administrative functions, who have leadership roles, who have functions outside of the scope of directly producing the billable product to the client.
Yep.
So that's how you differentiate in a service business, is you look at it and you say, who's billable, who's not.
Yep. Yep.
And the billable people go in cost of goods sold.
Yeah, excellent. You spend most of your day doing accounting and CFO work for clients, so you're pretty much cost of goods sold here at Ignite Spot, all your wages.
That's correct.
Yeah. I spend most of my day doing marketing and working with the managers. I don't work on clients ever.
Right.
So I'm overhead.
That's exactly right.
I'm not cost of goods sold.
Yep.
Yeah.
And just to differentiate, and it's a good point, just because you have overhead and not cost of goods sold wages, it's not always a bad thing.
Yeah, sure.
But it's understanding the difference and being able to look at them differently.
Mm.
So if you had these wages that are billable or these manufacturing costs to make the mouse, they go into that cost of goods sold section.
Okay, so all of those costs would line up here.
Right.
Okay.
So in this example, you can see we've got merchant fees.
Yep.
So we're buying products, we got to pay merchant fees. We have to buy the actual materials for the mouse.
Okay.
And we have to pay merchant fees because we're swiping our credit card to actually purchase those materials. We've got postage and shipping because we're having the product delivered and we're delivering the product.
Yep.
And then we have payroll that we've already discussed. Some of our payroll is going to be allocated here.
Yep.
Then we've got some freight in. So sorry, we had the postage and shipping above, which is just actually delivery to clients. We've got the freight in here, which is us actually purchasing the materials and having it delivered.
Yep.
And then we've got the actual materials to create the mouse.
Okay. So really just time and material is cost of goods sold.
Yep.
People's time and the material for the thing.
Yep.
So you got to keep all track of all that, and that gets pasted in here. Your bookkeeper will have tracked all of that throughout the month as they're paying bills and they're entering payroll. So that if they're doing their job correctly, if you have a good bookkeeping system, your cost of goods sold will be right. Most of the time, though, when I get into a set of books, cost of sold is very, very wrong. It's very wrong. And it takes a little bit of massaging to kind of get it's just a classification thing. Your numbers are in there, they just got to be put in the right buckets.
But that's exactly why I wanted to spend a few minutes talking about it, because this is actually one of the most important parts of your financial statements, and it's one of the most ignored.
Yeah,
so
it really is.
That's where I really wanted you to understand what the cost of goods sold is and why it's there.
Yeah. Does anybody have any questions about cost of goods sold while we're in this? Anybody want to ask, in my business, we do this. For example, is this a cost of goods sold or overhead? You're free to ask that in the chat box below, and we'll let you know whether you should be classifying something as cost of goods sold or overhead. Okay, I'll watch for that as we keep going.
Okay, so after that, we get our total cost of goods sold, and then we come to our next line, which is gross profit.
Okay.
Gross profit is, again, one of the most underutilized metrics on a financial statement, and I think it's one of the most important.
Yeah, for sure.
And the best way I can describe it in layman's terms is to come out and say, this is what it would look like if you ran your business in your basement and didn't have any other cost to run the business.
Yeah.
So if you were just sitting in a bedroom in your basement running the business, this is how profitable you would be.
Yep.
So that's where I look at this and say, okay, can you be a successful business just doing what you do at the most streamlined level? And depending on how that number looks, gives us a good sense of where you can go from here.
Okay.
So on this example, you can look at this. We've got a gross profit that looks fairly decent.
Okay.
And then we've got a gross profit percentage of 64%. I always insert a percentage for gross profit.
Yep.
And the reason I do that is because this tells me how much money off of every dollar you make you could actually keep after building your mouse or paying your employee, who is that direct billable person.
Yeah.
So in this example, for January, we get to keep 64 cents on every dollar we make to apply towards our operating costs.
Yeah, to pay for the business.
To pay for the business
the
to
lights
actually run.
Yeah, yeah. So real quick, we had our beginning cash of 97,584 for January. We did 314 in revenue, or in income. But then we had a whole bunch of cost of goods sold. So if I add all these up, it equals 114. So now I have to subtract from my revenue my total cost of goods sold. That gives me my gross profit. That's where we get the $200,000, right?
Right.
So how do you figure out the gross profit percentage? Because this is the most important percentage in most businesses, not all, but in most. All you're doing is you're dividing that gross profit, that 200, by your total sales of 314. And that gives you 64%. You said it's a decent looking gross profit. How do we know that? Just because the percentage is high, or?
Right. And so that's a really good question, is when we look at that gross profit percentage, the higher the percentage, the better you're doing.
Yeah.
The more money you're making for every dollar that you create.
So it looks like in the future, 64%, 62%, we got a little less efficient as a company.
Right.
59% even more so less efficient. Then we got back on our game in April and so on, right?
Right.
So we want that number to go up as much as possible.
Right. And so you asked the question, is that a good percentage?
Depends.
It depends.
Yeah.
Yeah. And this is a good way to look at it, is there are a lot of companies out there who are high volume. They sell a lot of small things, and they don't cost much to make, but they don't sell them for very much either.
Yep.
And so a company like that is going to be a low gross profit business as a percentage,
Yep.
but they're going to base it on the fact that they're selling a whole bunch. And so you can have a successful business that has a low gross profit percentage, but those people have to play a really high volume game. They have to sell a lot of what they do.
Yeah.
Otherwise, it just depends on your business model. I think anything over 50% in general is a good gross profit.
Good start, yeah.
Yeah, if you're a service-based business and you're doing 50%, that's a great margin.
Yeah.
If you're creating something from a manufacturing standpoint, that's a decent margin as well.
Yeah.
I have no problem with that. But depending on what it is, we may look at that and find out there are efficiencies or inefficiencies.
Yeah. And every industry is different.
Right.
Right? So, yeah. Okay.
So now we've got our gross profit percentage. I look at this one and say, okay, this is pretty healthy. I look at January and say, okay, we've built our mouse.
Okay.
We've sold a bunch of them.
Yep.
Here's the cost of selling those mice. Now I'm sitting here with $200,000 left over to pay for bills for the month.
Keep the lights on. Yep.
That's not a bad start.
Okay.
So then what we
Unless
do,
we have $400,000 of
exactly,
light bills.
Exactly right. Because then what we do next is we go down. We've already just cut and pasted this out of our profit and loss.
This is more of the P&L.
Right. It's just more of the P&L. This is our operating expenses. These are the costs to keep the lights on. You'll see here we've got the meals and entertainment. We've got our bank fees. We've got some small computer equipment.
Rent, gas, everything else.
Insurance.
Okay.
I mean, it's just the cost of running the business.
Here's the salaries and wage, but this is for the overhead people like me, right? That aren't building mice. They're just doing administrative stuff.
Exactly right. So then we come down, and I've highlighted again what the total expense was for the month.
Okay.
So that total expense is $119,000.
That's how much overhead we have.
Right.
Okay, that's the sum of all these other expenses that we just talked about.
Yep.
Okay.
So then I come down and I've added a line that says the percentage of expense to revenue.
Yep.
So up above, we found out that we have a 64% gross profit margin on this company.
Yep.
But we also now know that 30% of our revenue for the month went to pay to keep the lights on.
Yeah, well, 37, it's almost 38%. Yeah.
So that's a number I look at and say, okay, do we want to understand more about that?
Yeah.
Sometimes we look at that and say, well, that's a decent percentage. I'm comfortable with that.
Mm-hmm.
But when we see that number getting up in percentage, are you really comfortable saying, well, 37 cents on every dollar I made went to pay for admin, went to pay for the lights, went to pay for everything just to keep the company going.
Mm-hmm.
The only one exception to that, though, and this is really important, is, and this is a good example of this because I put it as a big number in here, is included in the operating expense is your advertising and marketing budget.
Mm-hmm.
And so if I were to look at this, I always want to treat that number just a little bit differently.
Because it's a growth component.
Because it's a growth component.
Yeah.
It's not a sunk cost, as they like to say.
So just to summarize real quick, you've added up all the overhead. That's the 119,000. And then you wanted to say, well, how much of that is everything that's sold? So you took that number and you divided it by that month's income, which was $314,000.
Right.
By dividing that number, you get a percentage, which is 37%, almost 38%.
Right.
And you're going, wow, okay, for every dollar we generate, we're spending 38 cents just to keep the lights on.
Right.
Okay. And then, of course, the difference after everything's left is you got about $80,000
of net income.
Of net income. Not cash, but net income.
Yeah. So that's how we get from the beginning cash to now we've just put in and gone over the profit and loss.
Yep.
So here we have our net income. We can see I've frozen up top that we've got the beginning cash at $97,000. So obviously, if we take $97,000 plus $80,000, we're going to have about $177,000 worth of income, of cash left over at the end of the month, right?
Sure.
So let's scroll down a little bit to line 68. Wait, we don't have $177,000 worth of cash. We only have $109,000 worth of cash.
And this is where most businesses go out of business, guys, because we take what we learned in school, 2 + 2 = 4, and we think, well, the answer is 4. But in accounting and in business, it's not the case simply. And it's not because accountants are mean and we like to do things off, horribly. It's not that. It's the fact that as a business, you have so many ins and outs constantly. It's accounting for that movement of stuff. Because your business never really freezes long enough for you to say, okay, we'll stop doing everything we're doing just so you can figure out your numbers. The business is not stopping. It keeps doing things. People keep paying you. People keep needing to be paid, and so on. And because of that, we have to deal with the difference between what's on the reports versus what's actually happening in real life. Okay, and that's what causes the headache. Most people think they have more cash than they have, and then they have a bad day when they have nothing left.
Yep, that's exactly right. And I can't tell you how often I've heard the comment, well, I made $80,000 this month.
Where's it at?
Why don't I have $80,000 in my bank account?
Yeah.
Get that question all the time.
Yeah. And why do I have to pay taxes on that $80,000
exactly.
if I don't have it in my bank
Exactly.
account? Yeah.
So please understand your net income off your profit and loss is a nice telling figure about the success of the company. But it actually doesn't help you understand what's happening with your cash.
Right. So for you guys who love to look at your profit and loss or your income statement, that's the same report. You love to see what you sold and what your expenses were and what came out at the bottom. That bottom line, for those of you that are living your business by looking at that bottom line, you could be misguided on your cash position because you're thinking that's what we made for the month. When in actual fact, it's what you earned. Doesn't mean you've made it because people don't pay you on time. All sorts of stuff happens, right? Just because you earned it doesn't mean it's in the bank account yet.
And this is where the entrepreneur has to take a leap. And they have to take a leap out of the profit and loss because all entrepreneurs love to start with their profit and loss. Say, what does that bottom line say? We love it too, but we actually love it second best.
Yeah, in fact, I've actually heard most when I get on sales calls with people, most of them say, I don't even look at my balance sheet. Like, I don't even care. I just show me a good, clean P&L. I want to see how I did for the month. I get that, but that's half the story, and it's the second half of the story.
Right. It
really is. And for those of you who feel like you're always behind on the cash flow kind of, forecasting scene, it's because you're ignoring your balance sheet.
Yep. I think if you're going to gauge the overall health of your company, it actually starts with the balance sheet.
Yep.
And so the balance sheet actually tells me a lot more than your profit and loss does for 1 month. I can look at a balance sheet for 1 month. It'll tell me a lot more about the health of your business and where you've been and where you're going than looking at a profit and loss.
Yeah, so learn to fall in love with that thing.
Yep.
It's an important report.
So what happens now is, like we said, we've talked about the beginning cash. We've got to our net income, but we still haven't matched our bottom line cash of how we got to where we did from a cash standpoint.
So we have to do a little reconciliation here.
Right. We've got to understand how the balance sheet is actually affecting our cash.
And we have to do that because there are things that happen within your business where cash is moving in or out of your doors that aren't actually income or expenses. And that's a problem for you because you're looking at the income and expense report to make all your decisions, but there are things happening that aren't income or expenses that are mucking with your cash, right?
Mm-hmm.
Things like loans, movement of inventory, the timing of AR, AP,
Right.
All of that stuff screws up your cash flow
Exactly
really fast. Yeah.
Yep.
Yeah.
So to Eddie's point, this is where we're going to look at the timing of things in the balance sheet.
Okay.
The balance sheet is actually really tricky when it comes to cash flow.
Yeah.
This is the hardest part for me to explain to a lot of people. So
Yeah.
I don't mind if you chime in after I explain this and say, I don't
Ask your
get that.
questions, yeah.
Please repeat that,
Yeah.
because this is the hardest concept to understand. So what we're trying to time for our cash flow projection and how we've performed from a cash flow standpoint is we're trying to understand how the balance sheet has affected our cash balance for the period we're looking at. For our first example, we are looking at the month of January, saying how has the balance sheet affected our cash in January?
Mm-hmm.
And the way we do that is we look at what the balance was before. So we look at, for January's example, we'll look at December 31st balance, and we'll look at January 31st balance, and we'll look at the change between those two balances.
Yeah.
So when we look at this accounts receivable of $2,576 in January, that's not our accounts receivable balance.
No.
What that is that's telling me, because it's positive, it means it's increasing cash, which means more customers paid us than what we invoiced out to customers.
So, right, this is where your head explodes. So just hang in there for a second, and please, again, ask questions. So again, you're just taking December's balance sheet and January's balance sheet. You're going to QuickBooks.
Mm-hmm.
You export them both into Excel.
Right.
And then you line them up in columns.
Correct.
Right. Column A is December's balance sheet. Column B is January's balance sheet. And then column C, you're just subtracting the differences.
Right.
You're doing January subtract December.
Correct.
Yep. So January subtract December, and it will show you the differences. Now, we don't care about all of the differences on that thing,
Right.
But there are certain key accounts that we really care about that are screwing with your cash flow. Receivables, accounts receivables is one of those.
Right.
So in this instance, you looked at January's receivables,
Mm-hmm.
subtracted it from December's receivables at the end of on the report. Again, make sure that they're last day of the month balance sheets, right?
Correct.
You got to have them at the same day, same period, everything. You got to compare apples to apples. So December 31 and January 31. But when you subtracted January 31's receivables from December 31's receivables, we had a difference of $2,576 positive.
Right, which means we collected cash
Mm-hmm.
in excess of
$2,576.
exactly.
Okay. Whew. Right?
So easier example, let's choose this just because it's an easier one for people to understand, is the credit cards.
Okay.
Because people understand how credit cards work.
Yep.
You swipe it, you pay it down. You
Yep.
swipe it, you pay it down.
Yep.
That's the role of the credit card. And so when we see a positive number in January of $2,776, that means we were happy with the credit card. We swiped it a little bit more than what we paid the balance down.
Okay.
So if we had a month where we started the balance with $0 in our credit card, we were swiping away, and then we paid some down by the end of the month.
Yep.
Our ending balance would be $2,776. So if we paid it off every month or started a balance at zero at every month, then you'd be able to see that. But what this is telling me is, okay, we swiped it more than we paid it off. So we're going to owe that $2,776 at some point in the future.
Okay.
So then when we look at the next month, we say, okay, now we're in month 2, balances are going up and down. We can see that it was $17,379 for February.
Right.
Negative.
Yep.
What that means is
We got serious about our credit cards.
we got
paid them off.
serious and paid them off.
We got a little scared.
And it took away our cash.
Yeah. And you can tell when you do this, guys, if it's negative, it's making your cash flow go down.
Right.
If it's positive, it's making your cash flow go up in this little section right here. So the change in the accounts receivable periods meant that you had more cash coming in. Right? That's what happened. But in inventory, we had $40,000 in cash going out, which to me says we probably bought a whole bunch of inventory this period. Okay. And Ryan can explain what that means in a minute. But just if you see a negative, that's bringing cash down. If you see a positive, it's bringing cash back up. And all of these little entries are what's creating the difference that will tell us how we go from our net income from the period to our actual bank balance.
Exactly right.
Yeah.
So to your point, inventory goes through swings. Sometimes we take our inventory that we've got on hand and we sell a bunch of it.
Yeah.
Sometimes we're buying a bunch of it to store it on hand.
Yeah.
And the ups and downs in that inventory, whether it's getting paid off sorry, not paid off, purchased or actually sold is where we actually track this. Because when you buy inventory, it's supposed to go on your balance sheet as inventory.
It's not an expense yet.
It's not an expense yet. It's not in your cost of goods sold when you buy it.
So let's mess with your heads a little more, guys. You guys doing okay? By the way, give us a thumbs up in the chat if you're not totally brain dead yet. Okay, the reason why inventory is a mess is because when you buy it, you don't get to expense it right away.
Right.
Cash goes down because you bought inventory. And then on your balance sheet, this number called inventory goes up. Okay, inventory is an asset. You own this asset. It's sitting in your store.
Right.
And then this is my customer walks into your store, buys something. The moment that happens, you get to cash goes up because the customer paid you. Right? But now you get, and income goes up as well, but you also get to book an expense. You take something out of inventory and you show it as cost of goods sold. Again, like selling the mouse, right? The moment that I sell the thing, I get to recognize all of these parts as cost of goods sold. Until then, they're just assets sitting in my warehouse, but I still own the dang things. Nobody's bought them yet.
Right.
That's why it's tricky, right? That's why these numbers mess with your head. And inventory, because it's negative here, we went out to our suppliers and bought a whole bunch of inventory one day. Exactly. And we stocked up.
Yep. And just a quick side note, because I think it is important to understand, because I do see a lot of companies who just try and expense it when they buy it.
Yes.
When we talked about the sales above, and we talked about our gross profit percentage.
Yes.
Why we do it this way is because we're trying to match the sale to the actual cost, so that we actually know how profitable we really are in actually selling our products. If we just expensed everything when we bought it, we actually wouldn't know how profitable we were per mouse that we sold.
Well, that's one of the most common things I get when I'm talking to people that are considering hiring us, is they say, I want to know how I did in January. Well, unless you do it this way, you can't know, like Ryan's saying, because if you went out and bought $40,000 of inventory right now, which is what he's telling us, and instead of doing it the correct way, you just expensed everything because that's easier, right? What's going to happen if I scroll up here into my P&L, I'll have all my revenue for stuff I sold, but then I'm going to have an inventory of $40,000 sitting right here because I would have expensed all of it.
Right.
Which means my total cost of goods sold would be wrong, my gross profit would be wrong, my profit percentage would be wrong, everything would be wrong. And then you're looking at your report going, we had to have done better than that. What's going on?
Exactly right.
So nothing makes sense to you, right? And that's a problem.
And it also hurts us when we come down to the balance sheet, because another problem I see with companies is they don't understand their inventory cycles. They don't understand when they should buy inventory, how much they should have on hand.
Right.
And if it's all just jumbled into an expense number, there's no way to know that.
Yep.
Sorry, quick sidebar, but I think it's important to understand.
Yeah.
So then we go through our whole balance sheet and we do this game of comparing the last period to this period and seeing how has the cash changed in each of these accounts.
Okay.
The last one I want to talk about today is the distributions.
Yes.
So distributions are a funny number. And you notice here that it's a positive in the first month. Why is it a positive in the first month? Well, as business owners, you actually have the ability to either pull money out or put money back into the company. And so this is where we're tracking where you are pulling money out or putting money back into the company. This is not a wage. This is not a W-2 salary. So if you're just pulling money out of the business saying, there's this much in the bank account and I want to take it out, this is where you just pull that money from.
Yeah, you can do that. You can take money out of your business as long as you account for it correctly, knowing that down the road it will affect your taxes a little bit and your whole situation. I mean, we need to be aware of all that stuff, right?
Right.
So
in this example, we're looking at it saying January, we put in, our cash was affected because we put in an extra $14,000 of cash back into our business.
Yeah.
And we took out small amounts, and it looks like we were happy at the end of the year with where we're at. So we decided to pull $13,000 out as December. As either a repayment for what we put back in or a bonus for performance.
Yeah.
But it's up to you how you treat that. So this is where we account for those distributions.
Yeah, and you taking money in or out of the business is not an expense. It's not income. When you put money into the business, that's not income. That's a balance sheet item. When you pull money out, that's not an expense. That's a balance sheet item. So every time you're touching cash flow yourself, you're screwing with your cash flow forecast. And you just need to know how that affects everything so that your cash flow down 12 months on the road, that report is still right. So you have to add that stuff back in or subtract it back out.
Right. So if we look at this example now, we stay right where we are. You can see that beginning cash was $97,584 for the month.
Very top. Yep.
Our net income for the month was $80,811.
Okay.
Then in the balance sheet,
So we think we'd be at 177-ish somewhere.
177-ish. And we went in and we bought a whole bunch of inventory.
Yep.
We paid down some debts.
Yep.
Or maybe we paid down a line or something like
the
that.
Other liabilities.
We paid off. We increased our credit card. We put some money back in, and then we came down to our balance sheet activity and said, "This is all." Our balance sheet was affected a negative 68. Our cash was affected by a negative $68,000 from our balance sheet in the month of January.
Yep.
And you can see when looking at this, we've got some months that are negative, some months that are positive.
Yep.
And it'll swing like that.
Yep.
So then all we do is we take that 97,000 plus the 80,811, and then we subtract off that $68,000 of balance sheet activity. And what we have left is our cash balance for the month. So we look at it and it is positive $109,000 is where we ended the month of January.
Mm-hmm.
So that was our actual cash flow for the month.
Mm-hmm.
That's where we're basically taking our cash flow report, which is really important to understand. We're smashing together our profit and loss in our balance sheet.
Right.
That's how we do it. That's a month's worth.
Right.
Now, if you look in February, if you go up to February on line 7, where we've got the 109,000.
Okay, right up here.
Yep. If you look at that, I've just formulated that.
Sorry, scroll back down. Sorry, guys, I'm all over.
I formulated that to equal the balance at January 31st.
So you just took the ending cash as of January. You pushed it up here to the beginning cash for February, which makes sense. We're just moving into the next month. And so really, this is our basis for projecting 12 months out a little bit, or what?
Right. So this is exactly what it is. So for this is our actual numbers.
Yep.
For 2019.
Okay.
This is what we actually did.
Okay.
If we now go to the projection tab.
Okay. So real quick, you've done this for every month for all of 2019.
Right.
Do you really need to do a whole year?
I think so.
I think so too. Why?
Because you have seasonality in a business, because you have different things that may happen as one-offs. You want to be able to see the body of work as a whole, because you could look at one month and panic, or you could look at another month and just be elated with how successful you are. But if you look at it over a period of 3, 6, 9, 12 months, you'll get a better picture of what you're actually doing.
Correct. Yeah, absolutely. So this first tab down here is actual. This is not the forecast. This is just what you did in 2019. Okay, so this is step 1.
Right.
So really quick to summarize, we're running out of time here, but I want to be fast. You know what you're doing. Open up an Excel spreadsheet. Download your profit and loss statement for each month of 2019, as well as your balance sheets. And then you're going to have to smush them into this tab like we've showed you, so you have your actuals. And you can see how you've performed for the year. And that will be the foundation for actually doing your projection on the next tab.
Right, exactly right.
Okay.
And so once you're done with this, and once I'm done with this, I actually copy it and I just paste it to the next tab, which is called my projection tab.
Okay.
So now what I've done here is I've got all my formatting.
So this should be 2020 projections.
We treated it as last year.
Oh yeah. Okay.
So we treat it as a full year, because what if this was 2020, I would have 12 months of projection and 1 month of actual.
Got it.
But I keep them separate for a full year for a very good reason that I'll show you in just a few minutes.
Okay. So real quick, Shadab asks, is it possible that I can get this cash flow format? By the way, I really love the way that you're explaining everything. Thank you, Shadab. We actually don't provide this for free. If you become a client, Ryan builds this with you and for you and helps you forecast your cash flow. But this format is being recorded. So when you go onto our website, it will be there for you and you can kind of follow along and build it yourself if you want to save some cash versus having us do it for you.
Yep.
That's a great question.
So here's the report that we start with our 2019.
Okay.
What I do is I just copy and paste it over.
Yep.
And then I delete all the numbers out.
Okay.
So now what we have to do is we have to start with the same January cash, because we know that, hey, that's where we started from a cash standpoint.
Okay.
But now we have to start estimating how we're going to do for the year.
Okay.
How do you estimate how you're going to do for the year? Great question, right? It's the hardest part of what we do. And I always tell people, you start somewhere. Whether you look at last year's numbers and say, I'm going to take a 10% growth rate, or we look at things that have changed in your marketing environment or things that have changed in your business environment and say, well, we anticipate that market trends are going to push us up or push us down, whatever it is. Or you can even just say, I want to base it on last year's numbers.
If you've been in business for a couple of years, you can see how much you've grown or declined year over year and use that as a basis. I will say this, if you're a new company, it's good to be positive and excited about your future, but you're probably not going to go from a startup to a $40 million company in 12 months. So be conservative a little bit here. We're protecting cash. You need to be excited about your business growth, but you also need to protect this stuff. So if you're assuming you're going to make $40 billion in the first 12 months of being in business, maybe you will, I don't know.
Right.
But if you start spending like you're going to make that much money, you're going to go out of business really fast.
Yep.
So
always look at last year's numbers if you have them, or last 2-3 years worth of numbers if you have them.
Yep.
Understand your market trends and understand the industry as a whole, and then understand your seasonality as a business.
And be honest with yourself.
And be honest with yourself, yes.
Yeah.
And what do I mean by seasonality?
Right.
And this is a really good example, because if you look here, November and December, we're projecting very high months.
Yeah, big stuff going on here.
Why would we project high in November and December?
And October, really.
Yep. Why would we project those high months?
Well, because we've done really well in the past in those months.
And what would cause a business to do well in those months?
Christmas.
Christmas.
Yeah.
I mean, understand what your seasons are.
Yeah, this is probably a retail business.
Right. It's probably a retail business that sells a lot at Christmas time.
Mm-hmm.
January's quiet.
Yeah.
Why is January quiet?
Yeah, May is miserable.
Because everyone's depressed after Christmas now.
Yeah.
They've bought everything they're going to buy from you. Now they're trying to pay for it. So your sales are low in January, high in November and December.
Yeah.
Other businesses have different seasons. A farmer has a much different busy season and a much busier collection time than a retailer who's selling at Christmas time.
Right.
So it's understanding the seasons where you make a lot of money and the seasons where you don't.
Yeah.
And so you have to factor that into your projections as well. So those are my suggestions. Understand your seasonality. Base it on prior year information if you don't know anything different. Always assume some growth rate. If you're going to, even if you're being conservative, I want to see you at least shoot for the stars a little bit.
Go for it.
And do a little bit.
Be honest as you go for it.
But be honest with yourself as you go for it.
Yeah.
So when you're doing your revenue, those are kind of my tips.
Mm-hmm.
So we've come in here and we've projected some numbers of what we thought we would do in 2019.
So you hard-coded these numbers.
I hard-coded those numbers in.
These are not actuals. These are.
Sometimes what I'll do is I'll do a percentage and I'll take some percentages and compare it to last year's percentage growth. Okay. Sometimes I'll add a percentage to this line based on the actual tabs from prior years. That's where when you have these actual tabs, you can actually start creating formulas.
Yeah.
To say, this is how I think I'm going to project.
Yeah.
So that's how we get the cash, that's how we get the revenue projection. Then when we look at our cost of goods sold, we either better expect one of two things. We better expect that our margins are going to be assumed to be the same as they were last year.
That's this number, when you say your margin.
Yep.
Number 20.
Right. Or that we've gained some efficiencies.
Yeah.
So in this one, we're saying we're going from a 64% gross profit percentage in January from the actual report we saw, that we're actually projection. We thought we'd do 66%.
So we think we're getting better as a business.
We thought we were going to be.
At managing cost or whatever. Yeah.
Right. And so that's where we look at those and say, when you're projecting, they better be somewhat in line with a percentage from what we've seen in the past.
Yeah.
Because your cost to build things, unless you're getting new vendors, getting new processes, outsourcing in different ways, your percentage should stay somewhat in line.
Yeah.
But you're always trying to create some savings.
If I had seen, for example, this to be like 87% or something,
Mm-hmm.
I would probably question your forecasting and think that you're a little too positive because you're not being consistent with how your business actually operates.
Exactly right. So then once we've got those projections in for our income and our cost of goods sold, this is the easy part.
Okay.
So now we go to our overhead.
Okay.
Overhead for most businesses, the cost of running business, unless you're going through massive expansion,
Shouldn't change too much.
shouldn't change too much. Again, I mentioned the advertising and marketing before. That's its own animal. That's the one item in the operating expense.
Spend.
Well, that's where the budgets do change a lot.
Yeah.
And we can see fluctuations. But other than the marketing and advertising, this should resemble, unless you're going through high growth or high attrition, this number should look like it has in the past.
Yeah. I mean, your numbers will change a little bit because as you get bigger, you use more things, but your overhead really shouldn't scale as much as we allow it to. We get fat as businesses because we get lazy, right? But if you're being diligent with your overhead, it should be somewhat consistent. Now, real quick, just a profit tip or a pro tip. I mean, I have seen a lot of businesses spend all of their time penny pinching in the overhead, trying to save. Okay, let's call the phone company and let's try and cut $7 off of our phone bill this month. Accounting team, you go spend the week trying to figure that out.
Right.
Is that really efficient, or should we be spending our time in cost of goods sold trying to make that more efficient?
You should always spend your time at first in cost of goods sold, making that more efficient, because those savings grow with your increased revenue.
Yeah.
Your savings from getting your phone bill down or whatever it is will give you it's going to be a small savings that'll help you a little bit here and there. You'll give yourself a pat on the back and say, I save $50 every month. But if you shaved 1% off your cost of goods sold,
major change.
You grow $500,000,
yeah.
that 1% follows that $500,000.
Makes a big difference. Yeah.
That's huge.
Yeah, yeah. So you want to definitely be diligent with your overhead, but this company, for example, is what are we? We're a $5 million company, right? Over the course of a year. So shaving $50 off a cell phone bill may not be the best use of our resources.
Right.
Maybe it would be better to get efficient in our cost of goods sold arena.
Yep.
Yeah.
So that's a really good tip from a budget standpoint.
Yeah.
Okay, so then what we do here is, for the most part, I usually just take prior year information
Put it all in.
and just put it all in. Say,
Okay.
This is where we're going to start. I'll spend some time on that marketing and advertising on line 37.
Okay.
That's the one area in the operating expense I always say, okay,
Let's get this just right.
let's get this just right. And then the only other area I generally do spend some time on is the salaries and wages, because just like you said, as we grow, we have a tendency to say, I'd like an easier life.
Yeah.
And that's where we actually create some inefficiencies sometimes, or efficiencies, depending on how we look at it. We just want to understand that salary.
Yep. Yep. Okay.
So now we've got our total expense. We've got our net income that we've projected.
Yep.
We've got our projected balance sheet. I don't have to explain this. I just take trends and just do my best guesses with the balance sheet to say, this is what we think we're going to spend on credit card. This is how much debt we have. This is how much we're going to pay down. This is how much as an owner we think you're going to take out or put back into the business this year. And we just go through those and we just determine what we think the balance sheet is going to do to your business for the year.
So maybe you would do like just a quick planning session and say, we think we're going to buy a lot of inventory in the first 4 months of the year. So we're going to spend 70 grand here, 56 grand here, a lot here, whole bunch here, and then we're going to start reaping the benefit of that a little bit, right? So you can plan that out. That's all you're doing, is you're using trends, and you're kind of saying, what are we going to try and accomplish this year as a team?
Right. So now that we've gone through this exercise, what we can now do is we can look at what we've projected from a cash flow standpoint, because we're doing this so that we can see what's going to happen to our cash.
Yep.
So from a projection standpoint, we started with $97,584. That was a real number we started with.
Okay.
We started with the right number of cash and said, assuming all these things happen and we get to do all these things and meet our wish list to get this type of growth, what happens to our cash? The nice thing is that in December, if we meet our goals, we're going to have $757,000 worth of cash, where we started the year with $97,000.
Good year.
That'd be a really good year. But why do this month by month? Well, let's take a look at April.
Okay.
In April, we decided, because of whatever reason, whether it's growth cycles, whatever else, that we were going to buy a bunch of inventory on line 59 in April.
Yep.
That's $215,000. What did that $215,000 do to our projection?
It ruined us at the end of the month.
It ruined us at the end of the month. We have a negative $64,000 in the bank.
We just went out of business.
We just went out of business. So although we can look at December and say, if we do this, we're going to be really successful, great year, we have to understand our pain points still. Yeah. And that's where, I'm sorry, I get that you want to purchase all this inventory in April, but we better have a really good reason for it, or a different format, or a different solution.
Or you need a big bank loan.
Or a big bank loan, because that doesn't work.
Yeah.
And that's why we do this monthly, is because there are hiccups even for every successful business.
Yeah.
Even if you're positive cash flow every month, if you're not cash flowing positive enough, you can still hit a period, a day in the month, where you're just like, payroll's due tomorrow. I'm getting a bunch of customer checks next week. How am I going to pay for this?
Yeah.
So this is what the cash flow from a month-to-month standpoint is meant to tell us.
Yeah, yeah. Excellent.
So now that we've done our projection, and now that we've done our actuals, what we have now is we have a summary tab.
Okay, so let's go to the summary tab.
Yep, go to the summary tab. And all I've done here is, what I do is I come in and I say, okay, every month I want to track key metrics from what actually happened versus what we thought was going to happen in the projection. And so under the actual numbers, I've looked at the key accounts. I'm just looking at, from a summary dashboard standpoint, this is where I want all business owners to start, is just the dashboard. As I go, look at your cash, look at your revenue, look at your cost of goods sold, your operating expenses, your income, how the balance sheet affected your cash, and then your ending cash balance for the month. Let's understand those from an actual standpoint. Then below I come in and I've just formulated in the key numbers, same key numbers from the projection, and said, okay, let's understand what we projected versus the actuals every month in those key categories. And then I come down to the difference. You notice the difference in January and beginning cash is 0 because I started with the same number in cash.
And why did we do that again?
Because we started the year in January. We actually knew what the cash balance was when we were building the projection. So then we come in and say, okay, where are we getting this right and where are we getting this wrong? And if you notice, in some months our revenue is positive, which means, hey, we're doing better than what we projected. And in some months our revenue is negative, which means we're not doing as well as we projected. And a lot of companies, when they do these cash flows, they like to go in and create one that says, here's our projection, and we'll put in the actual numbers every month right beside it and just create one cash flow report. I create the two for a very specific reason. And that specific reason is I want to know how well I'm doing at actually projecting. And if we lose that history, if I lose this comparison to say, how did we do in January compared to what we thought? How did we do in February compared to what we thought? You're going to continue to make bad assumptions about your projection because you'll forget where you were wrong in your euphoric moment of, we're going to be amazing. And so we have to know these things. And this is where I look at it and say, okay, looks like we're beating revenue a lot of the time, but at the end of the year, we were really hoping for a better November and December than what we had. And so now we have to understand the seasonality of our business a little bit more. And so having this detail and this comparison of the actual to projection helps us actually refine our projections to get a little more correct.
Okay, yeah, excellent. So if you're a business owner and you're getting this, and you need to make decisions, are you coming to look at the projection tab to make your decisions, or are you making your decisions off of the differences tab? How do you run your business with all of this information? Right,
and this is where I like this in 3 dashboards, because I want this dashboard to help us make some decisions. Because what we did is in the projection, we came in and said, this is how we think we're going to do. And to the level you're getting close, great, you're projecting well. You can feel comfortable about how you're going to look 12 months from now.
Right.
To the level you're just completely missing the mark, you have to refine your projections to understand where you're going.
Yeah.
So they actually all work together. And the difference is, if the differences are very close, then we don't care about the differences.
Okay.
We only care about the differences where we're wildly missing on our guesses of where we think the company's going.
And there's some big differences here.
Right.
Yeah, there's some big differences. So if I see a lot of big differences, does this mean that we need to go in and kind of massage our projections a little bit and try to get them a little closer to reality?
Yep, and we have to understand, it allows us to start asking the questions why.
Why, yeah.
Why did we miss so badly? Because I'm not as concerned in January that we missed expenses by $15,000 as I am that we missed our cost of goods sold by $27,000. For good or for bad, it's just a bigger impact. Why did we miss by $57,000? It's in our favor, but why did we miss so badly? Because maybe we're not giving ourselves enough credit. And so I look to this to say, where are the big dollar misses? Where do we want to start our examination of making improvement on the company or understanding the whys?
Right. Awesome. Okay, so we have a projection here. We have what actually happened, and then we're looking at the differences between our projection and the actuals and going, wow, we were way off on some areas. And having a meeting as the management team, hopefully at the end of the year, to address the differences so that when you do the 2020 projections, you're not out in the weeds.
Right. And as you're doing this, if this was 2020 and we just started this projection, we could look at January and say, oh, what did we miss? How do we need to change our projections now? So
maybe for an applicable thing for you guys to understand how to do this is, since it's January 20, well, now it's February. Good grief, this year's going fast already. But you would sit down and you would forecast out 2020, right? You would take the beginning balance, you forecast all of that out. And then every month you would come in and you would add the new month's actual in. You would just keep adding those actuals in it month after month, but you would not change your projection.
No. Well, I would not change the actuals.
Yeah, don't change that. But you can change your projection if the business model changes.
I can change the projections going forward.
Right.
I will never go in and change January's projection. That already happened.
That's happened. So that's important to understand. Okay, so we create our projections for the full 12 months in January, and then month after month we add the actuals in to see how we're comparing, right?
I'm more than welcome to change the projection going forward.
Yep. So if it's April, for example, and I see, wow, I've got, $33,000 in expenses that we're off by, major issue. We need to address our projections in May going forward and make some changes real quick.
Right.
Okay. So you're trying to kind of fine tune that thing in.
Exactly.
Yep. So this is what you would have. This view is what you would have at the end of the year in December. You'd have all three of these dashboards fully filled out.
Right.
Okay. But you're not, just to be clear, you're not filling all three of these out at the beginning of the year. You don't know that. You only know what your beginning cash was and what you're projecting out to be.
Right.
You know all your historical stuff, right? This top one, the actuals get filled out month by month as you go.
Correct.
Yep. Okay, cool. Does this make sense to everybody? Do you guys have any questions so far on this? We've got a few minutes left with you, and I want to make sure that you can ask any questions you have about your businesses. We've got some great business owners in here with us today, and I'd love to hear about you, what it is you're trying to accomplish in your company. We're standing right here for you. This is a complicated topic, so feel free to, down in the chat box below, you can ask any questions you have. And there's no question's a bad question, obviously, especially when it comes to accounting and cash flow, because it is complicated. And this is your livelihood we're talking about. We want you to do well and to feel confident in your business today, not to walk in and kind of feel like you're running things in the dark, which is a pretty common feeling, to be honest. But we do understand that this is a complicated topic, which is why we do these free webinars. We do them every month. I'll tell you about this while I'm waiting for you guys to type in your questions down below. We do this every month. It's called Lunch with a CFO. And if you go to our website, ignitespot.com, you can register for these each time we put up a new website or a new webinar. So while this is pulling up, again, I'm just waiting for any questions that will come in. Look, there's Ryan on our homepage. Yay, Ryan. Did you know you're on our homepage right now?
I didn't.
Yeah, he didn't have a clue. But if you scroll down, the orange section here says how to create a cash flow forecast. This is where we have the current webinar going right now. And they'll have a countdown timer here to tell you how long it is until the new one starts. And you'll need to come and book your seat, and you can always jump in. We do these for free every month. We don't charge for them. We just like spending time with you guys and sharing hopefully some important information. But while I got you here, does anybody have any other questions they need to ask or anything that you want us to cover again? Nothing? We doing okay? Good enough. I think we hit it. All right. I don't have any questions for you guys, so that must mean you are cash flow wizards and you're ready to go out and tackle. If you need help with any of this stuff, let us know. This is what we're here. We do this all day, every day for businesses around the country. You can go to ignitespot.com and click the Get Started button. You can get our pricing and learn more about us. All right. Thanks, guys. Have a great day.
Thanks, everyone.